We will look today at put-call ratio, which has hit a lowest level in close to 3 years, and I will explain what put-call ratio is and why do we need to care about it. As a result of additional market breadth divergences, which I will also show, we may experience corrective action for stocks in the very near term. Bearish engulfing also was spotted on several charts, such as Dow Jones Junk Dead and Junk Dead, and that adds to the evidence that corrective action could be coming any minute now. And Canadian dollar hit close to is approaching the 22-year low as dollar index is moving higher against other currencies as a result of the various events in the world. Gold hit records in the meantime, and we will look at the latest trade for gold. All this and more in today's edition of MasterChartsTrading.com market recap for January 31st, 2025. Looks like we made finally to the end of the month. Hit the like button, subscribe to this channel, make a comment, share this video. I will try to also get the members only video sometime this weekend, but I'm having a little bit of a trouble with technology, so hopefully I'll get it out, but stay tuned anyways. All right, so first let's look at market breadth and what it is and why should we care. So market breadth is a measure of participation of the number of stocks in the movement of the stock market. And down below here we see S&P 500 index, and up above here we have what's called percent of stocks above the 200-day moving average. So notice that it dropped pretty significantly since December, actually late November of last year. We had a pretty precipitous drop, and actually we hit about 50% and then bounced a little bit, and now we're at around 62%. So the point I'm trying to make here is that while the market breadth has dropped, the stock market actually made a new high. So this would imply that the number of stocks that are above the 200-day moving average that are moving higher is decreasing while stock market is making higher highs. What does that mean? It means that there is a very limited number of stocks that are participating in this movement of the stock market higher. So, you know, Magnificent Seven come to mind, and various large cap securities have been propelling the market higher, while the average stock has not really been participating as much. Now, this measure is not like outrageously consistent. Sometimes we have these divergences and nothing really happens, and then they will just disappear. This time could be different because, as I'm about to show you, we also have another market breadth measure which is very out of shape, not out of shape, but it's just very overextended in the wrong direction. Another measure of the stock market breadth participation of the number of stocks in the advance of the stock market is the what's called Bullish percent index. Now you can look up what that is if you go to StockCharts.com and look for Chart School, and then look for Bullish percent index here. So it's a little bit of a interesting. I don't want to look for it right. Oh, there it is. Bullish percent index. Yeah, there it is. So it's based on this funky looking what's called point and figure charts. Some people use them. I never use them, but they are useful in a sense of what is how many stacks are on the buy signal and how many stacks are on the sell signal. So this shows how many stacks, what the percentage of stacks within the S&P 500 are on the buy signal. And currently we have 56% of those stacks on the buy signal. But what's more important is this divergence once again. So we have kind of picked out, I mean, we had even higher levels back here. So technically speaking, this divergence has been going on for a while, since maybe October of this year. And notice that we've been just decreasing and decreasing. So the latest sort of decrease was from about 70 in early December of last year till about 56% now, while the stock market actually went higher. S&P 500 actually went higher. So this again shows that there is a number of stocks participating in the advance is decreasing. Once again, this means a narrowing of the breadth of the advance, or not as many stocks are participating in this advance. So finally, I wanted to show this chart, which is put to call ratio. So put to call ratio is how many puts we have and how many calls we have. We take the number of puts each day, and we divide by number of calls each day, we get a number. I went a little bit further and I made like so this dark black line or blue line is a 10-day exponential moving average of the put to call ratio. The reason for that is because the raw data is very how do you call it? It's all over the place, basically. Oh, I'm sorry. There it is. Dots. Yeah. So, man, they really changed this. Oh, there it is. Okay, so notice that this dot plot is very just all over the place, and it's very difficult to interpret it. So to smooth it out, I made it into an exponential moving average of that number, each day's number. And notice that today and actually yesterday we hit a low in favor of calls, so put divided by calls. So we're in favor of calls to a very overextended degree. Notice that we have hit 0.77 or so in favor of calls. And if we go back like 3 years, we can see that this is the lowest level since 2021 December, so like 3 years basically. Now when we have this many calls, the corrective action is quite likely. So what I'm expecting is we're going to correct some, but we don't know how much. Lately corrections have been very shallow, and in fact notice that this 200-day moving average down below here of the S&P 500, we haven't even hit it since like a while back, since 2023, October 2023. So we're definitely overdue for a meaningful correction, and meaningful meaning that we'll pull back towards the 200-day exponential moving average. What does that mean in practical terms? So we can look at S&P 500 and 200-day moving average. We can turn it on. I don't normally use it, but notice that the 200-day moving average is very close to my blue support resistance line. So again, you can find out more about those lines. So we're expecting corrective action to take place sometime, I would say pretty soon, and something of this nature perhaps. So maybe into late February, April. Maybe we'll just kind of correct in a wave-like fashion rather. I mean, it's impossible to say exactly how we're gonna correct, but you know, that's like a normal sort of corrective action. So that pullback, if it materializes, even it's possible that it may not materialize. That's about 6% pullback. So in the grand scheme of things, that's not like a huge pullback, but it is relatively large because we haven't had, you know, pullbacks in a really long time. To get us into a bear market, we need to drop significantly more, about 15% towards this yellow support resistance line. So we're still ways off, and most likely we will see some sort of a, you know, corrective action, bottoming pattern, and then yet again a buying opportunity. So something similar to what we had back in 2023, for example, when we pulled back towards the blue line, bottomed out, and then rallied. So this is, you know, kind of like what I'm expecting in the near term. Another, of course, interesting point here is the fact that we just had a bearish engulfing pattern. I mean, granted, it's a daily bearish engulfing, so not a very we can look at the weekly chart as well and see if it's also a bearish engulfing, but no, I don't think so. It does look like it's tapping out though. Like this could be a shooting star candlestick, so potentially we may be in for some time, a few weeks of corrective action. So bearish engulfing, meaning that yesterday's candlestick, this green candlestick from January 30th, is completely engulfed by a candlestick from January 31st, today. So bearish engulfing. Looking at high yield bonds, we see the same we see the same bearish engulfing pattern today. Now these are all-time highs. We just hit all-time highs for high yield bonds. High yield bonds and junk debt correlate highly. So I showed this past chart in the past. This is a high yield bonds, and down below here is a correlation coefficient to the S&P 500. So that's you can see that they correlate quite highly. So in other words, one goes up, the other one goes up as well. The other one goes down, the other one goes down as well. So if we see a pullback or bearish engulfing on the high yield bonds, then we should pay attention because stocks could be also correcting next. Dow Jones, DIA, is a ticker symbol for Dow Jones ETF, also bearish engulfing. So we're seeing multiple bearish engulfing on multiple major indices. Potentially we may see a pullback in the few days to few weeks ahead. All right. Switching gears, we're currently looking at dollar currency index on daily time frame. So dollar currency index is currently in an uptrend. We just hit a 2-year high and been pulling back since mid-January. But I think we will again attempt to see to get to new highs. Now, normally gold and dollar move in the opposite direction, but of late we're seeing something completely different. I'll get to gold in a second. I just wanted to show United States dollar versus Canadian dollar. And since now we blame Canada for pretty much everything under the sun, we're going to impose, tariffs on them for some odd reason. I don't know. I'm not really agreeing with that too much, but there seems to be a reaction to that, obviously, and this is Canadian dollar hitting a multi-year highs, but at the same time, it's not only that, it's also the fact that Canadian dollar is approaching multi-decade lows. So we're currently looking at US dollar versus Canadian dollar on a weekly time frame, and this is a very kind of dangerous looking pattern for Canadian dollar, because notice this kind of like double top. We're approaching become a triple top, and if this indeed is a double top, maybe this is a cup and handle kind of business. A breakout above this cup and handle could put us way up. In other words, the dollar, Canadian dollar could collapse. So the depth of this pattern is about 20%. So if it breaks above this previous multi-decade highs, or the multi-decade lows, because this is US dollar versus Canadian dollar. So US dollar is winning this right now. US dollar on top, Canadian dollar on the bottom. So US dollar is winning this battle, and if it really occurs, then Canadian dollar could depreciate even further. Currently, you can buy a Canadian dollar at $1.40, but if this pattern plays out, we can see a depreciation of about 16 to 20% to $1.70 for each dollar, Canadian dollar. And that would be at least I'm not sure if it's going to be an all-time low, but yeah, actually it could be an all-time low should that come to pass, because this is a previous all-time low, unless we can go further. Yeah, this is a previous all-time low from 2021. Let me see how far the data goes. 1978. Yeah, so does not look good. Not sure if I agree again with the policies, but the fact of the matter that right now we're seeing dollar dominate pretty much all the other currencies. And despite strong dollar, gold, this is gold, XAU divided by USD, despite all of that dollar strength, gold is hitting all-time high. This is an actual all-time record high. We've never been up here. So gold is currently at $2,799, almost $2,800 per troy ounce. And yeah, this is pretty wild. It's pretty wild. So we're seeing gold break to new records. We will monitor this. I have a position personally in GDX, gold miners. So I recently bought it just on a close above the blue line, and we'll see if this continues higher. And of course, should the gold continue higher, gold miners should benefit, of course. And that's it for this week's recap. Let me know if you have any questions. Don't forget to hit the like button, subscribe to this channel, share this video, head over to MasterChartsTrading.com, sign up for one of the products. You can also find the link in the description. So again, I have 2 products and 1 bundle. I have a yearly plans and I have the monthly plans. Both yearly and monthly plans offer free 7-day trial. So we have trading indicators, this lines on the chart, this green, blue, red, and yellow line. They're available for TradingView.com. You only need a free TradingView account. Once you open a free TradingView account, come back to my site, MasterChartsTrading.com, sign up there. Newsletters, I send out daily alerts about various securities that we trade, and I send out, usually on most weeks, I send out a weekly members only video. So sign up for newsletter, or both trading indicators and newsletters is the best deal. That's it for this week's recap. Please let me know if you have any questions. Thank you for watching. Have another great trading week. Bye-bye.